Let's take a closer look at why your fund manager can't help but lose you money, even when they find a winning stock like Meta. And this is what happens, okay? And this is the case whether it's Scottish Mortgage Company or Fundsmith or whichever fund you want to take. They're easy to kill, they're easy to beat for a very simple reason. It's a design flaw within the fund management industry, which is why I always recommend people pick their own stocks. And this is the problem. Let's say, for argument's sake, they called it right and they got in all the way back in 2016, 2017 into something like a Meta. And for years it was rising. Okay, there were a few blips, that's fine. And it's rising and it's rising. And they're crowing about how they took it from roughly 100 to roughly 400, a fourfold increase. And they're marketing it like crazy, the fund. And you think, wow, I want to go into this one, because for the last, what is that, 2022, 2016, for the last 6 years, it's only gone up. Well, this is where the problem happens, because once every 6 to 7 years, the market drops. So they advertise that, then it drops. Now, fund managers are not allowed to go totally into cash, so they could sell this, but they'd have to buy something else. They've had great glory with it. They're probably not going to buy something else in a falling market anyway. So you get this 80% drop, and it is snakes and ladders, and they've taken you all the way back to 2016 where you started. And all these gains that you had, and during these years you were planning, your wedding, your second house, your holiday, your life of retirement, because it had only gone up. In 1 year you fell. There's an old saying in the markets take the stairs on the way up and the elevator on the way down, meaning, they take ages to climb and whoosh, down in a jiffy. So that's the first problem. There's another problem with the fund management industry. See, you as a private investor, you could have got out there. How would you know how to get out? Simple. You'd have a rule where if it falls X percent, you would sell Y percent. Y would depend simply upon your risk appetite. So that bit's easy. Okay, now let's look at this move up. Okay, that is, what, 250%? Your fund manager didn't get you that. Because even if they stayed in and it went back up there, that 250% is worthless to you, because that just brings you back to where you were before. So they actually got a 0% return over 18 months. So you turn around and say to them, hey, hang on, Meta went up 250%. How come you've only got me a 0% return over 18 months? And they'll say, well, that dip that happened. Great. So they've wasted your time there, and they've wasted your time over here. Yes, of course, between this period and there, you got a return. Not great, given that that gave you a heart attack and this gave you bloody nothing. That's the fundamental problem. So we found a strategy for getting out of there. If it drops X, you sell Y. What about getting in here? Well, the fundamentals looked good in Meta, for instance, which is why on Telegram we said in January of 2023, we're getting back in. The value looked good, the growth looked good, the dividend yields looked good, the cash flow looked good, the momentum looked good, the Sortino looked good, and the alpha looked good. Actually, the momentum looked really good. Your fund manager doesn't know how to do any of that. That's the sad truth of why they inherently can't get you the returns that you want. And they're easy pickings for people like me to say they're easy to beat.